Harvest Profit What If Analysis tool. I have an example account here, Nick's Farm, and we're taking a look at the corn in his account, and we're going to take a look at the what if analysis and changing some settings on it and how it's going to affect our overall profitability for growing corn this year. So the what if analysis is a tool that is used to try to figure out, okay, well, what happens in certain yield and price situations that happen on the market with unsold grain. So for instance, in this case, we have corn. We have a little over 600 planted acres of corn, and our current APH for corn, our approved production history, our actual production history is 180 bushels per acre. Right now, we have 50,000 bushels sold of an estimated total production if we hit our APH of 111 or 112,000 bushels if you round up. And right now, our average sold price is at $5.50. And our basis, we're going to estimate it to be negative 60 cents here. Right now, our per acre production cost, this is pulled from our harvest profit account, is $850.44 per acre. That's going to cost us. And then our per bushel cost, this is, think of it as our break-even point is going to be $4.72. So you can kind of, as we scroll down, take a look and see, okay, well, if we make, if we have 180 bushels, and let's assume we get to at least $4.25, we will make money. We can actually click on this. We can kind of see the breakdown of, well, this is how much revenue we're having. This is how much our expenses will be. There'll be no indemnity or contract loss here because even though we're getting priced here at 425, we'll have enough yield to hit our contractual obligations. And even with a 425 average cash price for our remaining bushels, we'll still be profitable. We'll end up with a $15.07 profit per acre for our corn. We can take a look at what happens in an example where we do get an indemnity payment by taking a look at our guarantees. So right now we have a percent coverage of 70%. This is 70% of the revenue, so 70% of the spring price here that was recorded in insurance against our actual production history, right? Or a 70% guarantee of 180 bushels is what I should say, against our spring price here of 515. So in the event that we have, let's say, a bad, for instance, commodity prices decline, looking here at 275, if I go ahead and take a look here at what happens if we have 180 bushels at 275, or maybe a better example, 150 bushels at 275, we can see that we will have some revenue still. We have bushels that we have available to be sold at 275. We have expenses of 850 an acre, so already we're losing a bit of money, but our indemnity payment will pay us $146, make up for some of that loss. We still lose money though in the end. You can kind of see what happens. Once again, this is at 150 at a price of 275. What happens if we have 80% coverage instead of 70%, and we take a look at that 150 and 275 mark, and you'll see that our indemnity payment increases, which gets us, along with our revenue, to be above our expense line. And that means that we, with an 80% coverage level in this particular scenario, that might be a good option for us if we're able to kind of cover potential losses that we have. You can kind of see how this chart changed. Green areas are where we're making money. Yellow is right on the edge of making money or losing money. And then red, of course, is areas where we lose money. So we can try to reduce our potential for negative profit by using the what if analysis tool in Harvest Profit. Thank you.